Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is January 27th, 2025. And today on our call, we have the COO, Joe Thompson from Kits Eyecare. Kits trades under the symbol KITS on the TSX exchange, and it also trades on the OTC under KTYCF. The company is currently trading at $9.05 with about 31.5 million shares outstanding, or about a $286 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks a lot, Trevor. Yeah, great to have Joe back. Joe, you're always well dressed for these occasions. I love it. You make me look shabby here in comparison. So
You're
thanks
the,
for
you're the
that.
entrepreneur on this call. I love it. I love it.
Fantastic. Look, Kits is, the share price has sparked up a little bit over the last little while. You guys have just reported, I guess rough numbers for Q4 and the year. Things are looking good. So we figured it was about time to get you back here and start spreading some of the updates here. So why don't we, before we jump into the updates, for some of the new people that are with us today, remind everybody what Kits Eyecare is all about, and then we'll get into some of the exciting stuff.
Great. Yeah, that sounds great, Paul. Thanks, Paul. Thanks, Trevor, for having us. We'll do a very, very quick recap of some of the news we've released in the last week or so and the story, and then importantly, get into the questions. Your subscribers always keep us on our toes, so we look forward to these updates. Why don't I jump in if that's okay? Okay, perfect. Well, just as a reminder for folks, we launched Kits back in 2018 with a view to make eye care easy. It's a big category. 7 out of 10 adults require glass or contact lenses to see and just to get through the day, but it still, in our view, has not been disrupted by technology or automation, and it's still way too costly, way too complicated. So we set out to specifically on this big important category, take 90% of the cost out of the system of making high quality eyeglasses and pass all of that savings on to customers, and to do it in two ways, and not have a brick and mortar legacy store network, and to have all of the manufacturing on eyeglasses automated and through one optical lab that we have here in Vancouver. The tailwind for our business is really what we call the customer of today, millennials and Gen Z customers, the largest demographic now in the US and in Canada in terms of numbers. And we really feel like this is the category for the next 10 to 20 years. So into the results, how has the business performed over the last 6 years? We've had, Paul, as you mentioned, we did pre-announce our Q4 and fiscal year 2024 results. I put a note out into the market last Monday, a week ago. And we had our 9th consecutive quarter of just over averaging just over 30% organic growth. We were a little bit higher actually in Q4, 42% organic growth. The adjusted EBITDA 9 quarters in a row as well has been positive and increased beyond the 5% threshold. We were 6% adjusted EBITDA in Q4. Important for us, a couple things. Our marketing continues to be about flat, so we're not funding this growth just with excess marketing. We're keeping costs low and passing those savings on to customers. And important for this category are nearly 1 million active vision corrected customers. This category really works when customers come back again and again. And we've really proven that once we acquire a customer to Kits, they do come back. And again, over in 2024, over 60% of the revenue, even as we're growing across the fiscal year, over 30%. Again, over 60% of that revenue is coming from repeat customer base. So, easy, right? Just find a category that hasn't been disrupted, innovate into it, and grow endlessly. Well, there's a reason that few companies have really been able to disrupt this category, and even fewer disrupt it profitably. In our view, there are a couple recipes to growing and growing profitably in this category. Number one, build a foundation. And so we built, our central nervous system, or our foundation. We took investors through it in our first investor day in September in Vancouver. Is really the lab. It's the central nervous system of our operations, the data, the technology that sits on top of that. We've very intentionally built out this capacity for scale. We call it our $500 million infrastructure, or $500 million foundation. And we feel like we have the infrastructure to grow revenue to 500 million and likely slightly above that without really incurring significant capex. So the capex has been deployed in not just the machines and the building and the conveyors and the infrastructure, but also the data, the technology, and the people to power that. The second approach that we've taken, which is a bit unique, is really not requiring a significant amount of marketing spend to power growth, and looking at every customer as an influencer. And we can talk more about that in the questions. But this is really what's allowed us 2 fiscal years in a row to grow over 30% organically, and to do it with flat marketing as a percentage of revenue, in and around 13 to 14% on average. Last but certainly not least is our approach to capital allocation and building an infrastructure and a balance sheet that we feel will reward shareholders for the long term. And maybe I'll skip ahead here. And really, the foundation of that is consistent growth on revenue, and also on adjusted EBITDA. And you see the chart here. And also, it's just a real dedication to working capital, and a consistent approach that allows us to grow, have a strong eye on working capital, not invest in areas that won't generate either return for customers or return for shareholders, and then to get more efficient as we grow, which we feel like is the sign of a great business. Both on fulfillment, we've seen consistent leverage. We think there's more to come there. Same with G&A, and we think marketing remains relatively consistent. It's a simple ownership structure, and we feel like we have the team to take this business to the next level. So why don't I stop there? It was just a quick overview, because I think many folks have already heard the story. But back to you, Paul.
Yeah, perfect. Fantastic, Joe. Reminder, everybody that's listening right now, and I know we've got a number of interested parties. If you've got any questions, please use the chat function, and I'll ask the question. Listen, why don't we dive right into it? I think one of the things that we keep hearing from everybody that is an investor right now has to do with some of the things that are happening down south, less in your control. This chatter about tariffs. What, if anything, do you see potential tariffs doing to change your business? What do you see coming?
Yeah, we're certainly very aware of all the conversation, and a lot of it's really distraction, but our team is considering all scenarios. They've got a short, medium, and long-term plan to address it. I think it's important for us to look at the contact lens business and also the glasses business. On the contact lens business, our view is that there'll be less disruption there. What many of the products are made that we're selling from other partners in the U.S. And we feel like we've got a good plan for the U.S. and Canadian business. There's been a lot more conversation about the glasses business, which we manufacture here in Vancouver. at our state-of-the-art optical lab. And I think, for us, we've been breaking that into the Canadian glasses business, which, important to note, as we launched glasses a couple years ago, we launched initially with a greater focus on the Canadian market, the market we knew. And as a result, our Canadian glasses business has scaled much faster than the US glasses business. And we wanted to start with Canada, really prove out the model, and then grow more significantly in the US market. And so for our Canadian glasses business, there'll be no limitations on that growth. And really, that's where we see even more upside in the event that there is tariffs or retaliatory tariffs. We think we will really have a strong ability to gain share in the Canadian market even more rapidly than we are now. In the U.S. market, I think there's a couple of things that we have considered. One advantage that we do have on our glasses business in the U.S., while it is smaller, is we have a low average order value because we pass so much of that savings on to customers relative to the market. And so if the average retail of a pair of prescription glasses in the US last year was $350, our price is $38 to $48 on average for a pair of prescription glasses. So even if we absorb that, in a worst case scenario, absorb that potential tariff into price, we think we still have significant room to grow share, because others are going to be absorbing part of that cost into their infrastructure as well. And we have just such a lower base to work from. And then, additionally, we're looking at, as we've talked in the out years, our plan is to expand our capacity into the U.S. market from a manufacturing standpoint, bring a small, maybe a micro lab, and then scale it gradually, likely on the East Coast in the U.S. And so, in a worst case, we would probably pull forward some of that plan and relocate, a couple of our machines into the U.S. market and get started on the high velocity items there. From a CapEx deployment as a percentage of revenue, even under that scenario, we would really have a focus to keep CapEx as a percentage of revenue consistent in 2025 as it is in 2024. So we're running the full gamut. We've observed traditionally essential non-discretionary categories like healthcare, like eyeglasses, are the last to really get disrupted by these types of activities, because there are such powerful lobbying groups in the U.S. that are really focused on preventing a lot of inflation in that area. So but we are planning for the worst and anticipating all and watching the market as everyone is.
Fantastic. Okay, so let's dive back to call it Q4 here. 42% revenue growth. That's outstanding, especially on a larger base like you're seeing right now. Joe, what do you really see as the drivers for that acceleration of growth in that quarter?
It's a little more of the same for us, and it's the same story kind of quarter on quarter, which we like. We like to just continue to make more progress. Glasses was the driver of our growth, growing at 60% in the quarter, and powering the 42% overall growth. Repeat business was again a driver, and not just on contact lenses, but also on glasses, as customers see the value, try us out, maybe with the first purchase of a pair of prescription glasses from kits.ca or kits.com in the US. Maybe fewer upgrades initially, only one pair. And then, when our team delivers with same day manufacturing, gets it into the carrier network that day out to customers within 1 to 2 days, a customer will wear, these glasses for a month, 2 months, and then they realize, I've got money, insurance dollars just burning a hole in my pocket here. And when they come back, they're on average buying more than one pair and making more upgrades. So it's more of the same, just continued growth on Canada, on US, with new and repeat, but led by glasses.
So is it fair to say you're seeing an increase in average revenue per user? Is that kind of what's happening? They're coming there, maybe buying one or two, pairs of glasses, and then increasing their spend as time goes on?
Correct. Yeah, we're seeing
Okay.
average order value go up uh, on the whole
Mhm.
for our business, and then when we tease out new and repeat customers, we're seeing growth on those repeat customers is it's nice to see AOV growth, average order value growth across the board with
Mhm.
new and repeat. But really, what we're looking at is this category really works when people come back. Because
Mhm.
once you need vision correction, you need it for decades, and
Yeah.
um, and so our team's really focused on that repeat customer when they come back. What's in their basket? Are they buying multiple pairs? Are they
Mhm.
upgrading? That means they have trust in the platform, and they're more likely to say so. Yeah, yes is the answer to that.
Mhm. I'm trying to imagine being a competitor against you guys right now, and clearly your model is working. Are you seeing any sort of defensive moves by competitors, or is anybody crawling into your space and doing some of the things you are doing, or what's happening with some of these other players that are out there?
It's a good question. I'm sure that there probably is some reaction. I think part of that is sheltered by just the growth and the tailwinds that we're seeing. So,
Mhm.
when you have a category this big that's shifting online, um, even if there's a couple players doing well, both of them could do very well,
Mhm.
or three or four of them could do very well for years to come. I think the nice part, there was many years of building for
Mhm.
us, but the nice part about where we are now is this category, even though it seems so simple, it's
Mhm.
eyeglasses, contact lenses. It seems like it would be an easy category to disrupt, but there's just so many component pieces of it. It's a design company. We've designed thousands of different unique kits, frames. It's a manufacturing company. All of the profit in the eyeglass category is in the lab, and so you really need to get that. If you want to pass great value and great quality on customers, it needs to be a manufacturing company. It's a marketing
Mhm.
company. It's a technology company. And it can be a retail company as well. So there's so many different parts to the business, and that it as a result, that there's a few of us in the category that we feel really have a significant moat for years to come, as
Mhm.
long as we keep serving customers and serving shareholders pretty well.
Mhm. Mhm. Fantastic. Okay, so a couple questions in here. And the first one comes from Jesus. He says, "Hi, happy shareholder here. In October, we saw sells from several senior management near all-time highs. Any reason? Question mark.
Sure. Yeah, we have done one equity raise in the history of the company. It was the IPO in January 2021. As a result, there was a very high insider ownership. It was about 79%. Um, and so there was constant feedback on that in the market, um, and so as a bit of a release valve, the team did a minor secondary, just over $10 million, which moderately took down insider ownership to around 75%. And so, that was really the reason for it. The team obviously still feels incredibly strong about the opportunities ahead of us, and we're all very, very happy shareholders.
Maybe let's talk a little bit about the capital markets. I was going to ask you this anyway. As a business, it's clearly matured, but it's also matured as a stock. You've gone from, call it mostly retail holders to what likely is a little bit more institutional investor. Like what has changed as far as any kind of IR? What kind of plans you guys have in terms of communicating more? What can you tell us about sort of the road ahead as far as IR?
We I think the best IR really is just strong execution, and I think for the institutions, what they and many of them, I've been meeting with them for years now. before their initial buy. So this is not anything that's happened recently. They've been buying recently, which is great, and we're happy to have them as like-minded shareholders and building the next 3, 5, 10 years for the company. But these have been conversations that have been happening every quarter for years, and what a few of the notable bigger institutions have said is, Joe, we're going to start doing work here, and we're going to take note of everything you say, and we're going to judge you over a period of time on how well you and your team execute on what you say you're going to do. And as we got 4 quarters of results, and then 6 quarters, and then 8 quarters, now 9 quarters of 30+% on average organic growth, and really maintaining strong cost discipline on the business. A number of them said, okay, we've been watching this story for a number of years, and so I think that's really the first part. Is no IR plan is gonna do as much as strong results on the business, and that's all of our focus is just to continue that. And the second thing that I think helped is we did our first ever Investor Day in September, and it was a bit of a leap of faith. And our one of our fantastic leaders, Olivia, just did an incredible job coordinating that day and that event for folks. And we did it for 2 reasons. We did it because a number of folks had said, well, hey, when the stock price was $2 or $3 a share, there was talk about how do we get this stock to $10 a share. And now you're there. Is this like mission accomplished? And now that's it, we're done? Or is there still more to come here? And we just really wanted the opportunity to tell the story of all the hard work is done. We're now a public company. We built the infrastructure. We deployed the capital. And now, comes the fun part where we grow into that. Our view is, as we grow, if we can continue to execute as we grow, we will really have a great growth story, a great adjusted EBITDA story, but increasingly a great free cash flow story and cash flow from operations story, because there is so little capital required to power this growth. And so we were excited to tell that story. You kind of have that moment where you're like, oh gosh, if you build it, will they come? Is anyone going to show up to this this tour and this presentation? We're delighted to have over 50 folks there, and just a really dynamic, interesting day, and I think that really generated, and the highlight of that is starting from the lab, starting from the infrastructure, because we've heard so many folks say, well, the more I get to know a company, and understand how the widgets are made, the less exciting that is. And we just feel like at Kits, it's the opposite. My dad used to say, never approach a restaurant or a horse from the rear. We kind of take the opposite approach. When we start the tour, we start the Investor Day with a tour of how glasses are made, because we want folks to see, wait a minute, why are you paying $400 for a pair of prescription glasses? That's bonkers. Here's how easy it can be made when technology and automation and great technicians come into the story. And so I think those are some of the things that really got things going again, and continued the momentum. And now for us onwards, it's nice to see the share price grow. That's great. We have high confidence that with continued execution, this is not a $10 share story. It's well beyond that.
I'm going to steal your dad's saying. I love that that saying. And by the way, we were fortunate. Trevor and I were fortunate enough to be there at the Investor Day. It was a spectacularly well organized day, and I completely agree with you. I mean, to understand what you guys are doing here, and I'd say how complex and simple at the same time your business is, was really, really impressive. So, I mean, talking about products a little bit, another question's come in here is about some of your new products and some of the launches you've done, including smart glasses and things like that. Maybe talk a little bit about some innovation that you guys are providing for products.
Sure. Yeah, we're at a point now where we can really plant a number of seeds and ideally watch a number of them grow into gigantic oak trees and a couple. I'll share just a couple of them that we worked on. We got more coming this year. Smart glasses was a fun, interesting new product launch for our business. It is very small as a category overall, so it's important to caveat that. We like it because we see so much building in behind the scenes with big companies like Meta, Google, Apple, apparently, building into this form factor. And so, where we're going to compete on that is, we feel like the prescription lens that goes into that, we'll make our own frame, our own kits, smart frame, as well. And, we think it will do terrific, but we're also going to carry the Meta frame and when Google launches, or ideally when Apple launches, we'll carry theirs as well. And we think the opportunity for us to contribute in this category is in that prescription lens and in the lab work, because currently the way it works is you order a beautiful pair of Meta smart glasses, and they cost $300 to $350 on the Meta site, whatever the price is now. They come to your home in a gorgeous box, great unboxing experience. But then, of course, you put them on and you're like, oh gosh, I can't see. They don't have a prescription in them. So now I've got to go online, find a place that will cut a prescription into them, drive out to the store, and now it's a leap of faith. Are these guys going to know how to put prescription lens into this really complex? There's wires running through the hinges. And so we now are at the point where our assemblers, over half of our assemblers are experts at assembling and QAing prescription lens in a smart frame. And so we think we're going to be there when this market expands. We're not investing a ton of CapEx into it right now, but as it expands, we feel great as a seed that we'll be there to catch a lot of the commerce on the other side of that. And particularly in the area where we feel like we've got a competitive advantage. So that's one seed. We've really been expanding our private label Kits brand of contact lenses, and it's done remarkably well, passing the 5% share threshold, and well on the way to the 10% share threshold. And we launched color contacts. So Paul, if you want purple eyes or blue eyes, that can be yours. We think that's an emerging part. I think we're trying to invent in a number of areas. We're also inventing in our insurance space, and we think there's lots of work to be done there. The TELUS Health integration's been just a wonderful tailwind for us. It takes a year and a half to just build the technology, and then but it's this steady drip that comes of really wonderful customers that are very sticky that come in. We're going to be inventing in the U.S. insurance space more in 2025, so stay tuned for that. And then there's the invention that that folks don't see as much of, but is just as important to us, which is on the infrastructure. And so things like building a regional carrier network, so that you're not beholden to Canada Post or FedEx for all your shipments, but you have a more regional carrier network that, oh, by the way, is much more flexible in their delivery times and can deliver very quickly at often a lower price than the national carrier. So a bunch of out front innovation and maybe kind of behind the curtain innovation that we're going to continue to work on in 2025.
Never standing still. That's awesome. Okay, other question is around marketing expenses. I mean, obviously, you guys have been able to sort of flatline your marketing expenses, but can anybody expect to see a decrease in marketing expenses as a percentage of overall business?
Marketing is probably the area that we really enjoy inventing in the most, just because there's just this belief that the only way to grow revenue is to disproportionately grow marketing spend. And
Mhm.
we really feel, and we have since we launched the company in 2018. We really feel that the best invention and the best creativity really comes from scarcity. You have that scarcity, and the team has no choice but to invent new approaches. That you can't just plug dollars into the same 2 or 3 channels that everyone else does, and it changes for us the focus from what's been kind of characterized in the category as like growth hacking, where you find a new approach to an existing channel where you get a slight advantage versus everybody else. And that lasts for 3 to 4, maybe 6 months, and then everybody else catches up, and now you have to invent. And so you're really, you're not inventing for customers in that scenario. You're inventing to someone else's model, and then you're relying on no one else catching up or them not tweaking that model. And so as a result, we take it the other way. And that's why when we launched glasses, we said, well, we have to do something different. And the invention really came from our first pair free, where we said, okay, it costs us fully landed $25 at max to get you a high quality pair of prescription glasses, including the prescription lens, delivered to your door in a day. And we think that that's more just giving you those glasses for free is a better investment than spending $100 or $150 spent to Mark Zuckerberg at Facebook or Instagram to acquire, quote unquote, acquire you as a customer. And but that requires a leap of faith. You have to say, okay, well, we're gonna trust that when we give that pair to Paul, he's gonna come back. And he'll come back, and not only will he come back, he'll spread the word to others. And that worked out really well. And we were probably a little bit slower to invest in the influencer model, but out of first pair free, we really saw the influencers stepping up, and they played a large role. And once we saw the potential there, we really saw this ring around influencers around their hometowns, and saw tons of orders come in very concentrated areas of our marketplace. And then the team said, okay, let's tinker around with that model. And that really prompted them to launch Own This Town, which, for us has been a game changer. And we started it in Vancouver. And really, you take one market and you put surge advertising into that market for a limited period, 2-3 months, 1 quarter, and you're unmissable in that market. And people would say, what is going on? I can't get away from this kids brand. They're everywhere. They've got a store, a pop-up store. They've got they're on the metro. I see them everywhere I go. Everyone's telling me about kits. And really, when you look back and you think, here's how companies like Uber, here's how companies like DoorDash have really built. They've really built by these, city by city takeovers. And it allows you, as opposed to saying, okay, we got to get a big US Super Bowl ad, we got to blanket the country. It allows you to really hyper invest in a community, make it feel local, win those customers over with a great product and great experience, and then go back to sustain levels. And so that's what's got us excited. I don't think I think if we needed to, we could take down marketing. I think the business would support it. But I think, given the growth that we've had, I think we'll probably maintain that marketing spend, but just really focus it on expanding awareness, expanding glasses in our Own This Town.
Gotcha. No, it's well said. Absolutely well said. Okay, a question around share buybacks. You guys have an NCIB in place. Question here, it says, we saw some discrete buybacks at $8.50. Are there plans to continue with them?
Yeah, I think we've had an NCIB in place for a number of years now, and we haven't really acted on it. And gosh, we were talking about doing it when the stock was at $2 or $3, and unfortunately didn't send that signal at the time. And we won't make that mistake again. I think if there's a buying opportunity, I think it was a very small buy on the NCIB a little while ago. It was like 25,000 shares or something. But yeah, if we see the value of the company decrease to the point where it's at a significant discount, then we'll act on that again.
Yeah, not afraid to use it. Perfect. Okay, a few more questions here. Russell says, is there a point where you feel you'll have to expand your manufacturing capacity? Now, when we did the site visit, clearly there was still significant capacity at the existing facility, but you can max out. Maybe give us an idea what that level sort of looks like, and then when do you start planning for that if you haven't already started?
Yeah, we've seen on the busiest days that even without full 24-hour shifts in that facility, we've seen the potential for the Vancouver lab at least 500 million in revenue, which we think is probably somewhere between 4.5 to 6 years from now, getting to that level, and so um, uh, what we're constantly thinking about is how would we do phase two of that, and phase two probably looks like a micro lab where we take the high velocity items um, and just a smaller version of our Vancouver lab without the full surfacing and coating capabilities. But we open that micro lab in probably more on the East Coast, probably more in the US. It's a number of years away unless volume continues to grow or there's a need for another reason to pull that forward. But that's probably how we would do it. And then we've got the expertise on building and scaling a lab that we would just gradually and responsibly add to that lab as we get there, as we have a need for it.
Mhm. And Joe, sort of, you constantly are growing and maturing and innovating. So the challenges always change, and I always love to ask these questions, but sort of where you guys are right now, where do you see as your greatest challenges to continue moving forward?
Sure. Yeah, we're thinking about those challenges often. I think we've got the things. The biggest challenge I think for us is just really knowing and understanding what's working for us right now, and not letting those things get away from us. So we feel like we're a simple business. We have a straightforward focus, and we've got the low cost model and the low cost infrastructure that gives us a ton of flexibility to react to a number of things because we don't have a lot of cost in the system, and we think the market is moving to us, and that's exciting as well. So really, what are we worried about? Well, we're number one, we don't want those advantages to stop being advantages. We don't want to let costs get away from us, and so what's exciting on our business is because we have the low cost infrastructure, the delta between our adjusted EBITDA and our net income line is very small. There's not a big gap in there where there often is for other companies. So as an example, even in our industry, there's a technology perceived and focused business called Warby Parker, and if you look at the delta within the industry at a roughly comparable company, it's about 5% between adjusted EBITDA and net income. And for us, it's right in around 1%. And so that's a 400 basis point advantage, we think that we have for generating, free cash flow and keeping a lean operation and just resisting, spending. There's many temptations as you grow. And the temptations are, opening a ton of stores, spending a ton of money on marketing, or letting working capital get out of control and eating your cash. And so I think, the biggest focus for us is just avoiding, the footfalls and avoiding the temptations that come our way. Because as the market comes to us, we think we've got the best mousetrap. We think, while everyone else is running, our view anyways, everyone else is running a 5, 6, or 7 minute mile. We have the opportunity to run a 4 minute mile. We never want to lose that efficiency. And if there was another one, I think it's just we've tried to just be. It's okay if we're growing slower than the market or slower than we possibly could, as long as we feel like we're doing the hard work first and just being really thoughtful and being students of the market. And so, as we kind of get to this 350 million market cap, and $200 million revenue run rate. We want to be good students of companies that have gone from 250 to $1 billion in market cap, and where have things gone wrong? Where have they gone really well? And so, as you or others see great examples, we love to be students of that. Please send them any and all examples our way. That's our fun nighttime reading. I'm joe@kits.com is my email.
Problem is, we're using you as the example to a lot of other smaller companies. So keep doing what you're doing. Joe, last question really is around just as investors watching what you guys are doing, where do you think, like, are there catalysts or milestones that we should be paying the most attention to? Where should we focus our attention going forward?
I think we're gonna continue to keep as you execute, the expectations go up, and so I think we're gonna stay relatively conservative with our forecasts, and just really focus on continued execution on the top line, but also on the bottom line. So and marching quarter by quarter towards a couple of milestones. They're internal targets, and we talked about them at our investor day. It's not formal guidance by any stretch, but it was a kind of vulnerable for us to share some of those internal targets. And but if you were to walk the halls at Kits and in our lab and in our head office in downtown Vancouver, you'd hear folks talking about those markers. And those markers for us are quarter in, quarter out, continuing to hear exceeded on top, exceeded on bottom line. But as we think about the next 2 years, really growing to be a $250 million run rate revenue business, and really growing to be a 10% EBITDA business. And as we think about the 5-year internal target, it's to hit that $500 million revenue level from a quarterly run rate standpoint, and at that point really to be a 15 to 20% EBITDA business. And we feel like the roadmap's in front of us. We just have to continue to execute, not get ahead of our skis, and invest too much and lose that cost advantage, and just be good students of the market.
Joe, this is fantastic. Is there anything we missed, or is there any key message you want to make sure everybody walks away with today?
I think we had a great opportunity to be in market in Montreal last week for a day, meeting with really, really thoughtful institutional investors, and I think one of the things that we heard some feedback from them this morning on an early call, and one of the funds had said, I hadn't realized that we look at the numbers, but we hadn't looked underneath. And when we looked underneath and we saw your awareness build and your revenue build on glasses, you've got revenue across Canada and in the US on glasses, but really you've executed incredibly well in one core market, your Vancouver and BC market, and if you can bottle that execution up, that own this town execution up, and replicate it, if you go, we've got one store, it's more of a showroom in Vancouver, right on Kits Beach, and it's lined up around the corner on the weekend. We're going to have to put a little rope to for crowd control in there. There's just so much excitement to come in, and it's like a treasure hunt. And so their feedback was, if you can execute on this own this town model and do it in 5, 10, 20 markets, this is really going to be a great growth story as your glasses business continues to grow 60% last quarter, and continuing to grow. We see gross margin expansion, profit expansion, more leverage on that. This is going to be an interesting story. So I think that's probably one thing that might be overlooked, Paul, is folks look at the total business and say, okay, that's spread everywhere. Well, really, we've only got density in one key area.
Fantastic. I mean, I'm always marveled at the details that you bring to these kind of conversations, and how well thought out so many of these plans are. We've been speaking with COO Joe Thompson of Kits Eyecare. Joe, it's always great when we catch up. You guys have, you're hitting it out of the park, so we wish you continued success. and a number of us are shareholders. So happy to see what we're seeing right now. So thanks for your time today.
Well, thanks to you, Paul. Always great to. Now, let's do the next one in person.
Let's
Maybe
do
we'll
it.
do it. We'll do it from our lab, and then we could just walk around and show.
That would be fantastic. That would be fantastic. We'll definitely work to get that done. Would love it. Would love it.
Awesome. Thanks again.
Thank you. Bye for now.